All right. Okay. Let me share my screen. Oh, let me close these. It's preparing for test. Trading is taking a lot of time. Let me see my connection. Sometimes it's problem with TradingView, like it takes a lot of time to load stuff, but on the other sides, the internet's good. Bro, it's internal range liquidity to external range liquidity today. The ERL IRL cycle. If you're not well, you can just skip it. So anyways, the recordings are there, so you can watch it anyway. Health is wealth, you know. This thing's taking a lot of time. Like, just give me a second. I have to restart my internet. I don't know if the problem is with the internet or is it with TradingView, but anyways, I'll just restart it. Well, let's begin. Okay, so uh, it's everything right with the stream and with my voice. There isn't any lagging, right? If it's good that we can begin. Just let me know. Okay, great. All right, so yesterday we learned about structure, the advanced market structure, the short-term highs, lows, etc. Today we are gonna learn about internal range liquidity and external range liquidity. Okay, so there is actually a cycle that happens in the market. It's from internal range liquidity to external and external to internal. Now I'm getting into what this actually is. Okay, first let me write it up. So yes, I have to change the connection. Okay, so external range liquidity to internal range liquidity. Okay, so price is gonna go into external, and then it's gonna go into internal, and from internal it's gonna go into external. So there's a cycle, and the market runs like this. So it goes from external to internal and internal to external. Now, what is internal range liquidity and what is external? So we have a range. Range is basically like a range from a low to a high. So for example, we are here, something like this. This is our range, okay? Say this is our range from this high, from this low to this high. Now, this right here, this high, this low right here. Now, from here to here, it's a different range. Okay, so this from here to here is also a range, but on the lower time frame. Now, these lines right here that I drew, these represents external range liquidity. Okay, any high or low, simply. So if you are looking at an H4 high or low, that's simply an external range liquidity on the H4. Okay, if you are looking at daily chart and you see a high or a low, that's external range liquidity on the daily chart or on any other chart. So for example, now this is the daily chart. This is a high, this is a high, this is a high. So these are actually external range liquidity. This is a low. This is also external range liquidity. This is a low. This is also external range liquidity. Okay. This is external range. This is external. This is external. This is external. Now, there are going to be fair value gaps as well in a range, right? So let's say we have a fair value gap right here, and we have a fair value gap right here, and we have fair value gap right here. So these fair value gaps here are basically internal range liquidity. So basically, a fair value gap is internal range liquidity, and a high or low that you see is external range liquidity. Okay, now you know what, these fair value gaps on a high time frame, when you look at them, it's going to look like a fair value gap. So for example, this is daily chart, but if you go into the 1 hour chart or at the 15-minute chart or 30-minute chart, this fair value gap is actually going to look like high or low. It's going to look like external range liquidity or external range liquidity on the lower time frame. Now I'll get into examples of it. So in this chart right here, I have opened the daily chart, right? So you can clearly see this is the daily chart. Now, this is external range. This is external range. This is also, which is taken already. This one is also, okay. So all these highs are lows that you see, this one, this one, this one, this one, this one, all these are actually external range liquidity on the daily time frame. And these fair value gaps that you see from here to here, I'll change this color, okay. So this is a fair value gap. This is actually internal range liquidity. This is also a fair value gap. This is also internal range liquidity, okay. This is fair value gap. This is also external range liquidity. Now have a look at this price action right here. So we have a bearish order flow. So you see market gets into internal range liquidity. So here is our internal range liquidity. It gets into that and goes lower to take out external range liquidity. So when price was here, this was a low, right? Then price went into this internal range liquidity. So price is gonna go from internal range to external range. So price is gonna come lower, and you can see that it went into the internal range and then came back into the external range. Now we have another example right here. So price gets into a fair value gap, which is internal range liquidity. And then where does it go? It goes into the external range. It then once again goes into the internal range. And then where does it go? It goes into the external range. Now the external range can be here, it can be here. This is also a low, right? These are also lows. So it is also external range liquidity. This is also external range liquidity. So price is going to go into inefficiencies or internal range liquidity or fair value gap, whatever you want to call it. And then it's going to go into external range liquidity, as you can clearly see. Okay. Then we have like it is gonna fail sometime as well. For example, have a look right here. Have a look at this. There is an internal range liquidity. Price gets into it, but it doesn't go into the external range yet. Okay, so sometimes it's gonna fail. Okay, but you will see that most of the time this thing is gonna work. So basically, when we are in a bullish order flow, price is gonna go into, so when price goes up, like it goes, like it move, does like an impulsive move like this, it's gonna form an inefficiency, and there is gonna be a previous high right here, okay, in a bullish order flow. Once price does this and takes out the external range liquidity to left side of the chart, it's gonna go back into internal range. Then once this internal range liquidity is tapped, it's going to go back into the external range if it's in a bullish order flow. And then the cycle is just going to repeat. Okay, so that's how it's going to be. In a bearish order flow, it's going to be exactly inverse. So it's going to look something like this in a bearish order flow. So price is going to get into inefficiency or internal range liquidity or fair value gap, whatever it is. And then it's going to go into external range liquidity. Okay, and this cycle is going to repeat. So price is going to go into external range, then it's going to go into internal, then from internal it's going to go back into external. Now you know what is the logic behind this. So as I've told you that a fair value gap on the high time frame is basically a low or a high on the low time frame. So for example, let's have a look at this right here, this fair value gap. Now this is the daily chart. So daily chart is our high time frame. Now if I go into the M15 chart, for example, this is that fair value gap. You can see that it is actually a high on the low time frame. So basically, the idea is that the market goes up to induce the people on the low time frame. So market is going to go up first to tap that. Okay, I guess I missed it. Wait, let me see. Okay, it's gonna happen after this. My bad. Okay, so this is that internal range liquidity. Price goes up to induce the sellers in the market. Once they are induced, now price is gonna go back into external range liquidity. Where is the external range? It's here. So if I go into the daily chart once again, okay, now that it has tapped this internal range, so from internal it's going to go back into external. Now this is our external range liquidity. So if I play it out, okay, you will see the price goes into what? It goes into the external range liquidity. Now there is another internal range liquidity created. So after external range is taken, where's the market going to go? It's going to go into the internal. Now it has gone into the internal range liquidity. Then from internal, it's going to go back into the external range, which was here. So this is the cycle and it repeats. It happens like almost every time, like not every time, but it's going to happen most of the time. Okay, so price is going to go into internal and then it's going to go into external. It's going to go into external, then internal. And this cycle is going to be repeated. So now the logic behind this is simply that market has to retrace. And the market actually starts retracing once it takes out a previous high or a previous low. So in a bullish order flow, you will see that when market takes out a previous high, it starts to retrace. And at that retracement, it gets into internal range liquidity and it induces the people. It takes out the people who are already long because an fair value gap or internal range liquidity on the high time frame is basically a low on the low time frame, and you know what who places stop losses at their lows. So people, they just like place their stop losses at the lows or highs. Okay, so the market goes down, retraces, takes out the people who are already long, and then goes back up. Then once again it takes out external range, then goes back into internal range, and this cycle repeats. It happens like on every time frame. I'll show you examples right now. So this is the daily chart. You can see internal to external. Okay, then after that, once again, it takes out. So here's a fair value gap, which is not tapped, but here's another internal range liquidity. Price gets into it, then goes into the external, gets into this internal range, gets into this external range after taking out the internal range liquidity. Now let's have a look at this price action right here. So price is going up, right? Now you can see that price takes out this high right here. So this is external range. So now we can anticipate that the market might go into the internal range liquidity. So now you can see that price gets into the internal range. After that, it goes into the external range liquidity. Okay. Now here after this, you can see, so before this, there is this high, right? You can see that. It is taken out. Now we have internal range liquidity right here. We have this fair value gap right here. So we can expect the market to tap this internal range liquidity. It taps it and then continues going higher. Now, let's see example from here. So here is external range liquidity. The market takes it out. We have two fair value gaps right here. So both of these are actually internal range liquidity. Now remember, the market doesn't have to retrace all back up to, like, it doesn't have to take out every single inefficiency or internal range liquidity. It just have to take out the nearest. That's it. Now, I'm not saying that it won't go to this one. It can. But if you are like trading from here to here, your target should be this fair value gap right here. You shouldn't aim for this one because the order flow was bearish. So you have to look at the order flow and all those things. But like, hold on, give me a second. Okay, so you have to like look at the order flow and bias, etc. But while trading from external to internal, your target should just be the first internal range liquidity or the first fair value gap. So in this case, it gets into here, then goes back into the external right here and right here and right here. Then we have another fair value gap right here, which is also internal range liquidity. Price gets into it and then goes back into the external range liquidity, right? So this cycle just repeats and it happens on every single time frame. For example, if I go into weekly chart, okay. So right here, external range liquidity is taken out. We have internal range right here. See what the market does. It gets into the internal range, then goes back into the external. Internal, external, internal, external. Then the market reverses, and after that, external is taken out, gets into the internal. Then we don't really have a fair value gap. Okay, so we have it here as well. So internal, then back into the external range. Now let's roll out what happens afterwards. Now have a look. We were in a bullish order flow, right? Okay, but then right here, so technically the market should have went up from this fair value gap. So because we were in a bullish order flow, but right here, the market reverses and it doesn't respect this. And now it is respecting bearish fair value gaps. So this can suggest that we are getting bearish on the weekly time frame. So whichever time frame we are looking at, it suggests that. And you can clearly see that after this, when the market disrespected this fair value gap and disrespected this fair value gap, you can see how the market is continuing to go lower. And it's still not done. It's still going lower. Okay, you can see that. So, and yeah, so now let's get into another time frame. So this is now the monthly chart. Okay, let me find example. So here, external is taken out, gets into internal, then goes back into the external, right? So you can see how this cycle repeats. So now right here, external range is taken out, internal range, gets into it, goes lower. Now let's go into lower time frame and see if this thing works on the lower time frame as well. We have a shift in the order flow right now. We don't really see a clear example. Okay, we do have here. So price takes out external range, gets into the internal range, and then starts to move lower once again. In this order flow, in a bullish order flow here, we had that, takes out the high, gets into this fair value gap, which is the internal range, then start to go up again. Then takes out this high, gets into the internal, goes back up. So this cycle is going to repeat. Now, now you have to confirm it. Okay, you have to confirm if price is going to go from internal to external now, or if it's going to go from internal to external, or if it's going to go from external to internal. You have to confirm that. You will need structure to confirm that. So for example, if there is a previous high right here, and the market is just going higher like this, and there is a fair value gap created right here. So just because price took out the external range liquidity doesn't mean that you just blindly start to short it without any reason. Okay, you need to have confirmation. So once that happens, for example, this is the daily chart and there is a fair value gap below. So you just don't go and start shorting it from here. You have to go into the lower time frame. You have to use those, those time frame alignments. So you have to go into the 1 hour chart. Okay, so you go into the 1 hour chart and then use the structure to confirm if it's going lower or not. So on the 1 hour chart, price wanna go lower, it's gonna do a market structure shift. It's gonna do some, now this is actually the lower time frame. Okay, so market is gonna do something like this, and then it will start to have a bearish order flow on the lower time frame. So if that happens, then you can say that the market will go into the fair value gap. But if it doesn't happen and price just continue to go higher like this, then it doesn't really make any sense to keep shorting it without any confirmation. So you have to confirm it. Then the same goes for when price is at internal range liquidity. So when price is at internal range liquidity, it doesn't mean that you just start buying it from here in a bullish order flow. You have to wait for low time frame confirmation. So now, for example, this is how the low time frame might look if it want to go higher. So it's going to make a market structure shift. It might take out a low, which is it's most likely going to do. So it's going to take out a short-term low, make an intermediate term low, and then that's where you can buy right here and target for this external range liquidity. So this is literally how it's going to be. You have to confirm it. So for example, right here, there was a bullish order flow, right? Now price takes out external range, and now we have this internal range right here. So technically you should be buying from this internal range liquidity, right? But as I've said that you have to confirm it. So now imagine you go into the one minute chart and with a bullish bias. This is that fair value gap. You go into the 1 minute chart. So I will play this out and you just buy it from here, like directly from here. And you have your stop loss maybe placed at here or here. No one places it too long. Like some people are gonna have it here, some are gonna have it here. But let's say it's here. It's done, finished. So you're gonna be taken out of the market. So you have to wait for confirmation. Now let's see when in this bearish order flow, when price got into this fair value gap. Let's see if we got a bearish confirmation on the low time frame. So if I go into the 1 minute chart, so this is that fair value gap. Price taps it. We have a market structure shift. This is an indication that the market might go lower now. Now let's see what happens after that. And you can see. So price, like it goes down, then goes back up to take out the high, which can happen, but still you have got like an entry right here if you were going to short it, right? So then after this, it's now at the internal range liquidity once again. Now here, have a look. Here's the market structure shift. Here's the red on a short-term high. So there's a formation up an intermediate term high right here. You can look for an entry once again right here. And have a look at this. Price just, so you have to go into the low time frame and then confirm that thing. So on NQ, okay, so I'll go into the NQ chart right here and go into the monthly chart. You can use this for your bias as well. So when price was here, you might have seen it. I did posted it on my Twitter, and I basically did it in a live stream on my free Discord. Okay, so price was when it was here, I said that the market is gonna go lower, but when price took out this high, I just didn't say it without any confirmation. So price takes out external, but that doesn't mean that it's now gonna go to internal. We have to confirm it first. And here's a good example of it. So here's external range, price takes it out. Does it go back into the fair value gap? No. Okay, so you have to confirm it with the low time frame structure. So now if I go into the daily chart, here is a market structure shift. There is, I guess, an SMT right here as well with the NQ, with ES. Okay, so this suggests that, yeah, now we are actually going into this fair value gap. So market structure shift, red on a short-term high, SMT as well right here, breaks this low again. So now this confirms. So the structure on the low time frame confirms that now we are going to retrace back lower. Okay. Then you can see that price tapped that fair value gap on the monthly chart. Okay. So internal to external. Now, why do we use this and where can we actually use this? You can use this for your bias as well. How? Okay. So just like I did used it. Okay. So when price was right here and I was looking at NQ's chart on the monthly chart, I saw that price took out external range liquidity. Then when I went into the daily chart, I saw that it actually made a market structure shift. Hold on. Okay. So I saw that market made like a market structure shift and it took out a high and then broke lower. So now it actually confirmed that price is gonna go into this fair value gap. Okay. So that gave me like my monthly bias. It told me that where the market is gonna go. So now I have like a clear drawn liquidity, which is right here. So I was having like a bearish bias on the higher time frame, which means that now I can look for confirmations. And since I'm like a small time frame trader, this was just like a confluence. Okay, I didn't really need that monthly chart. All I need is H4, M15, M1, but it was just like an extra confluence to add, nothing else. Okay, so now what I will do in all this month is that I knew that the market is going lower. So every red on a high, every retracement into the internal range liquidity was basically an opportunity for me to get into a short position. And that's what I did. So I would wait for price to retrace. And once that retracement was over, I will look for sells. You can check that on my Twitter as well. You can go into the highlights and you can see my executions on the NQ chart. So I would wait for the market to take out like a high or get into a fair value gap. And then on the low time frame after confirmation, I would just short it. Okay, so that's how I would trade it. Okay, so you use it for your bias. You can like use it to understand order flow as well. So in a bullish order flow, price is gonna get into bullish PDRS and then it's gonna go into external range liquidity. So you can use it to identify the order flow. You can use it for your bias, and you can use it to anticipate if the market might retrace or not. So you can be two kind of traders. So there are like two types of traders. Some people prefer to participate in the retracement phases. So they will like just go long in a bearish order flow and target the inefficiencies or the internal range liquidity. And some people, they actually wait for the uh, market to retrace, and once that retracement is over, they just try to get in at that point. I personally like to wait for the market to retrace, and once that retracement is over, then I look for buying if it's in a bullish order flow, sell if it's in a bearish order flow. So these are like the uses of internal range liquidity and external range liquidity. So basically, when price takes out a high, you shouldn't actually look for buying opportunities right there. If it's in a bullish, or even if it's in a bullish order flow, you should wait for it to get back into internal range liquidity and then buy from there. Okay, so if you are having a bullish order flow, so you should like long from internal range liquidity in a bullish order flow and short from internal range liquidity in a bearish order flow. And you should short for after market takes out a high, okay, and then have confirmation on the low time frame in a bullish order flow, like if you wanna like target the nearest internal range liquidity, and vice versa for like shorting it. So if I'm right here and I'm like an H1 trader and price takes out this high, I will definitely not look for longs right here. I will wait for the market to get into the fair value gap, and then I might look for something there. But I will not just long it after the market takes out a high. So that's why ICT says that buy below lows and sell above highs. So this is why he says this. So it doesn't actually make sense to buy after market takes out a high and sell after market takes out a low. Okay, so this was for this lesson. I hope it was clear. And if you got any questions in it, you can ask me. So any questions? Okay, so got any questions, you can type that in. Till that, I will just do a quick recap. So basically, if a good class white is yes, and how to use it for bias. As I've said, like you go into the higher time frame. Okay, so I use it for bias only when we go into the higher time, only on the higher time frame. So for example, a weekly high is taken out like this. Okay, now I can aim for the nearest fair value gap. So weekly chart, price takes out a high. We have a fair value gap right here, right? You can clearly see that. Okay, so now I can target this. I can have a weekly bearish bias, but only if the 4-hour chart is bearish as well. So after the market takes out a high and it gets into like bearish, it makes like a bearish market structure shift on the 4-hour chart or something like that, then I can have a bearish bias for the whole week. Then after this, so we have this fair value gap. This is my target right now. You can see price gets into that. So you can get a scalp out of it. Okay. So when you are trading against the order flow, you don't actually hold trades for too longer. You just target like the nearest fair value gaps. That's it. You don't want to target external range lows in a bullish order flow. So even like if you, but on the higher time frame, of course. So this is weekly chart. So if you are trying to sell it for on the 4-hour chart or the M15 chart, you just have to target the weekly fair value gap. You won't target weekly lows. Okay, you won't target weekly lows if you are actually, if the order flow is actually bullish and you are trading from external range to external range. Okay, so this is how we use it for our bias. So you have to be on the weekly and the monthly chart if you want to use it for your bias. You can use it on the daily chart as well. So when price takes out a high or a low on the daily chart and there's a fair value gap in that range, you can then have a bias towards that fair value gap or that internal range liquidity. So that's how I use it for my bias. Like as I said, how I got my bias for NQ when I was like bearish on it. This was the whole idea behind it. Price took out external range then the daily chart on the monthly chart, and then the daily chart made a bearish market structure shift. So that indicated that the market is now going to go into this internal range liquidity. So that's how I use it for my bias. How do you understand market direction while in ERL? So if you have watched my yesterday class, okay, I like explained structure. So when price gets into internal range liquidity, so this is like on the low time frame. So when price gets into internal range, so this price action, this right here, this is gonna look something like this on the higher time frame. And this might be like that fair value gap. Sorry, so this is higher time frame, this is the low time frame of this price action. The low time frame is gonna look something like this. So it's gonna make a market structure shift. Then in the retracement, there's gonna be a lot of generated liquidity. And then when price taps this right here, this fair value gap, and then it makes a market structure shift. This indicates that now we might go into the external range liquidity, or the very for the high probable setup, you can wait for the formation up an intermediate term low of the market structure shift. This is more high probable than just like anticipating things based on market structure shifts. So that's how you know that that's how you understand direction of the market in retracement in IRL. So when price taps the IRL, you go into the low time frame chart and you wait for the structure to get bullish if you are in a bullish order flow. Okay, a bullish higher time frame order flow. And if you are in a bearish high time frame order flow, you go into the low time frame when price taps the internal range liquidity. Okay, once that happens, then you can like look for bearish confirmation with the help of structure. And I explained structure yesterday in the lesson, so you might want to check that out. What is IRL? I just explained it, but I will do it again. A fair value gap is simply an internal range liquidity. Okay, so IRL stands for internal range liquidity. For more details, I will recommend you to check this class after it's over. Okay, so because I explained it in detail, but in simple words, you can say a fair value gap is internal range liquidity. Okay, so here's a cool example. Okay, this is the Bitcoin chart. Can order block? No, order block can't be, because I just explained the idea behind a fair value gap. Okay, the idea behind the fair value gap is that it's actually a liquidity on the low time frame chart. Okay, so when price gets into fair value gap, it's basically taking out a low or a high on the low time frame. Okay, so that's why IRL has to be a fair value gap. Okay, so now have a look at this. Let's say price was right here. We are in a clear bullish order flow, right? Now price takes out high. Now you can expect it to go back lower. So imagine, okay, so this is now our nearest fair value gap, okay? It does all this nonsense, but have a look right here. Price gets into this fair value gap. So now imagine you start to look for longs after price takes out this high, okay, without having the understanding of internal and external range liquidity. So when price takes out this high, you go into the low time frame chart like M15 or H1 and you start to long. You will lose a lot in all this process. So you will lose like a lot. So the best thing to do is to wait for price to get into internal range. And you can clearly see that when price went into the internal range, it got back up into the external range. So you can see that the best place to buy will be internal range liquidity in a bullish order flow. And the best place to sell will be internal range liquidity if you want to sell it, okay, in a bearish order flow, okay? If you are bullish, you don't want to buy when external range liquidity is taken out. You should expect some sort of retracement after that, okay? Then after that, if I go into, let's say, the weekly chart, you can see that price takes out external range. Now we have internal range right here. Let's see what happens after that. So imagine you just start to buy after this high is taken out. Right here, price gets into this fair value gap, and then it still doesn't do pretty much a great reaction. Then it takes out this short-term low. So now remember, as I've told you, the best place to buy is below lows, right? So you are bullish. You are bullish, right? So when price takes out this low, you can look for buying opportunity there. So after price takes out this low, have a look at what happens after that. Market goes up to make new lows. So this is why understanding external range and internal range liquidity is very important. Okay. So any questions? I'll tell you once again, if you want to trade with the order flow, wait for the price to get into IRL and trade from there. If you want to trade against the order flow, okay, then you can wait for the market to take out external range, and then you can target the internal range liquidity. No, it won't always respect IRL, but you know what? It's like almost every time it's gonna respect ERL. What I mean from that is that when price takes out external range, okay? And so there's the external range. Let's say this is internal range liquidity. So most of the time, or almost every time, when price takes out external range, it's gonna come back into internal range, but it doesn't have to go back into external range again. It can just reverse after the bullish order flow, and now it can just get bearish. So external to internal works almost every single time, but internal to external doesn't always work. Like, you just have to understand the order flow and everything like that. But if you are like, if you don't even have, if you can't even identify the order flow, you can still get a trade out of external to internal range. So you have no idea where the market is heading. Let's say, okay, the market takes out a high, and then you just, here is the internal range. You can just go into the low time frame, look for confirmation, and just trade till here. This can be your TP, okay? But if you want to trade from IRL to ERL, you need to understand the previous order flow. So if you want to buy from the IRL, you need to understand that there should be like bullish order flow before this price action, right? So yeah. So any questions? No, I haven't. I have exams this week. So I don't think I'll be able to trade this week. Might be an off week for me. This is the thing I love about trading. Like, just trade when you want to, just don't trade when you don't want to. Like, you are not dependent. Yeah, exactly. It should be like, you should focus on the non-USD pairs more than NFP. Usually when we have NFP, we see consolidation in DXY, or it's sometimes like this kind of pattern. So it's kind of like seek and destroy, takes out highs and goes back into lows, then goes back up again to take out the high. So it's not like the ideal price action to trade in. So the best thing to do will be to trade the exotic pairs, like, for example, NZD, JPY, or AUD, CAD, etc. So you can just look for trading those pairs. They are pretty clean during NFP weeks. The best pairs to trade during London kill zone will be, as I've said, that the pairs that are related to London. So, like Euro, GBP, okay, the pairs related to Europe, DAX indice, okay, what other, uh, the Swiss franc pairs, okay, so those are like the best to trade, okay. What's your point of view on BTC? Okay, so basically when price was for BTC, okay, I'll clear this thing a little bit. Okay, so when price was right here, okay, I was bullish. I said that the market is gonna go higher into this fair value gap. This was like my target for the higher time frame. Okay, price was in a bullish order flow. Like now, the reason why I was targeting this was the bullish order flow of the price. So if I go into the weekly chart, okay, you can see that how market got into this breaker, took out this short-term low, like so it made like an intermediate term low, went higher, then got back up, got back down into this internal range liquidity, and then went into the external, which you can clearly see that this is bullish, right? It's clearly bullish. Now that it has tapped the monthly fair value gap, which is, I guess, right here, okay? It already took that, or I think it's here, okay? Let's find out. Okay, it's lower than this. So price already went into this fair value gap, and it's in premium of this range right here, okay? Now I'm actually looking for bearish price action. I want price to go lower. I expect the market to go lower now. Because if you look at the very high time frame order flow, it's still bearish right now. Have a look at this. Takes out a high with displacement, gets into fair value gap, reject lower, takes out a high, reject lower, and continues down with a bearish order flow. And I think this is just a retracement for it moves more lower. For example, right here, or even here, okay? So I expect the market to run lower, but I'm not just gonna blindly start shorting it right here just because I have the idea that it's gonna go lower, okay? I have to wait for structure to confirm that. So I'm gonna look for the at least the daily structure or like the weekly structure to confirm that we are actually going lower, okay? You know the protocol. So you have to confirm everything with the help of structure. So if you have an idea, you have a drawn liquidity, you have to confirm that drawn liquidity with the help of structure. So now I have to wait for some bearish signs. And once that happens, then I can look for sells, okay, on BTC. And I do expect the market to run lower to new lows. So that's my point of view. So it's like a cool, or is it like retracement into this monthly fair value gap. And now we can just go lower. Okay. That's my point of view. I haven't even opened the chart today because I was like busy. I would suggest not to trade on Thursday if you are like you're a USD trader or if you're a pound trader or indice trader. Uh, I will not like suggest trading on Thursday because it's the day before the NFP. So you know price action is really gonna be stupid. So you don't want to trade before that. So questions? London kill zone is actually 2 a.m. to 5 a.m. Yeah, sure, I'll explain that. So London session is 2 a.m. to 5 a.m. I have explained the times in third lesson, so you might want to check them out for like complete explanation. Okay, so I have explained the importance of time with like complete explanation. So check the third stream of the last week and you'll be able to understand it perfectly. The Asian model is basically, as I've told you in the time lesson, remember, that the market consolidates in Asia session. And then this model is specifically for EU and GU. So EU and GU are gonna consolidate in the Asian session. So, and then it's gonna put in a high and it's gonna put in a low in the Asia session. Then at the midnight opening time, so let's say this is the midnight opening time, if it's bearish, it's gonna go up. Okay, it's gonna go up to manipulate and create the high of the day most of the time. Okay, when it takes out a high, you should wait for the market to make a market structure shift on the 1 minute chart. Okay, like that's the model. Then you can like enter on the market structure shift, which I don't actually recommend. What you can do is wait for market to take out a high. So basically you wait for it to form an high resistance liquidity run, or you wait for it to make an intermediate term high. And once that happens, you can enter directly on the breakup structure right here, or you can wait for price to get into like a breaker block or a fair value gap or whatever you want. Okay, you can do that, place your stop loss right here, and then target the Asian low. So this is basically my Asian session model. Okay, but you should expect the manipulation to happen. Like you should expect the market to take out the high after 2 a.m. Okay, you have to keep that in mind. You want to see the market taking out the high after 2 a.m. Okay, not before that. Let's invert this chart for like getting in a long position. So you wait for the market to take out Asian low. And then once that happens, you wait for a market structure shift. You wait for a red on the low. And then you get like, then enter right here on a fair value gap or whatever you want and target the Asian high. Let's see if it appeared today. I haven't checked the market today. So let's see if it appeared. Yes, most of the time the market is going to take out the high or low in the London session. So it's Tuesday, right? So we have a low right here. This is the Asian low. And where is the Asian high? Well, I won't really take this trade even if it appeared, even though it didn't appeared, but I won't even take it. Why? Because I've told you, like in last stream, I guess I told you that you don't want to see the range to be too big. So if you see this is like a very big range, you don't ideally want to see such big ranges. You wanna see the Asian session to be small. Okay, that's the ideal like the ideal condition for this trade. So I wouldn't even trade it, even though it didn't appear, this model didn't appear, but even if it did, I would like not trade it. Yesterday, it did appeared. So here is the, okay, so here's the Asian high. Here is the Asian low. Now let's go into this candle right here. I'll go into the M1. There is the 2 a.m. time right here. Okay, so price first goes down, but didn't take out the Asian low. So we don't trigger the longs. Okay, then price takes out the high, makes a market structure shift, but still there is no intermediate term high formed. This is why I say I don't like to enter on the market structure shifts. Now let's see, there's a market structure shift with displacement. Now it's gonna take out a high. So now there's this short-term high, which is taken out. Breaks lower. So I personally enter directly on Brex and price breaks the structure. So I would have like placed my stop loss right here and targeted this Asian low. And you can see that it pretty much did it, right? So this is like basically my model. And trust me, you can make a living out of this thing. It's very high probable. So before 2 a.m., okay, before 2 a.m., there is a little difference then. Okay, so if it happens before 2 a.m., so for example, we have a high like this and a low. So for example, this is the Asian high and this is the Asian low. And the market takes this high, let's say at 1 a.m. Then now the market makes like displacement. It makes a market structure shift on the 15-minute chart. Now you need 15-minute chart. So you will want to see a market structure shift either on the 15-minute chart or on the 5-minute chart with displacement, okay, and with like a bearish order flow, okay. Then I would like go into the 1-minute chart after the after 2 a.m. and then look for like formation up an intermediate term high and then sell it from there. So that's how I'll do it if price takes out the high before 2 a.m. But I don't recommend doing that. It's not as high probable as if it takes out the high after the London session starts. So just don't enter there. Okay. I would recommend uh, to wait for when market to trade only when market takes out the high or low after 2 a.m. This is actually a very simple model, and you don't even need any bias for this. It's better to have bias, but you don't need it. You don't need it for this model. So even if you look, so let's say you were expecting bearish prices. Have a look at what happens after that. Price just goes up after it, but you'll still get you a trade. Okay, so you don't necessarily need bias for this model to happen. Okay, so it's not necessary that you must have like a bearish bias if you want to sell after the Asian high is taken out and then an intermediate term high is formed. So you don't necessarily need that. It's better to have a bias for like extra confluence, but it's optional. You are welcome. So questions? Anyone got any question? Yes, there aren't any questions, so I'll just end the stream. So goodbye, everyone. Have a good night, day, or whatever it is, and see you all tomorrow. Good luck for tomorrow's trading. Thank you. You're welcome. You are welcome. Good night.